Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 9th of September 2025. I'm Mark Gardner. So chip stocks were higher overnight as investors essentially focused on anything but the softening economy. It was very much a classic head in the sand sort of scenario. And look, the Friday employment numbers, while they're being talked about, the market has very much just skipped over. So we did end up having via the revisions the first negative number since December 2020 back in June. So I would imagine next month's will be revised down as well. But we've got inflation coming up this week. CPI and PPI. PPI is first on Wednesday with CPI then on Thursday, which is a bit of an irregular routine. Normally CPI is first. But as you can sort of see here, it was really the chip stocks. Oracle had earnings, and that drove things a little bit higher. But look, pretty mixed overall. I've got to say, Pepsi was hit. We had a little bit of a bounce back in some of the financials overnight, and that communication sector got a little bit hit as well. So yeah, look, I wouldn't say it's much to write home about overall. I think it was very much just saved. Saved by some good news in Broadcom, and the market is absolutely scrambling for its life to find any sort of positive to remain up here at these towards these record highs. So Nasdaq did eke out a new record high, but again, it seems like we're just treading water because we are expecting for the inflation numbers on CPI, a modest acceleration to about 2.9% from 2.7%. But look, that's getting towards 3%. So everyone's talking about about there being these 99% chance of a rate cut. They could be looking at 50, but I look, with inflation up around 3% and the effects of tariffs coming through, which was supposed to solve the trade deficit in the US, but it's actually worsened in the first 7 months of this year versus 2024, as has the debt. And, we're probably looking at, the Fed having to make a really difficult choice. And sad thing is they'll be blamed. They'll be blamed for it. Trump will just come out on the front foot. But as one very interesting comment from an economist on Bloomberg this morning, the Fed has to decide which baby to drown, either the inflation or the softening economy. So that's a very odd comment from an economist on international television. But I suppose you've got to get their name out there somehow. But yeah, so realistically, we're going to be looking at credit spreads on a pretty regular basis in the podcast moving forward. When they sit at record lows, which or historic lows like they are, a really good leading indicator of a turn in the market generally. And as you can see here, credit spreads popped here leading into. See, this is before April. They popped up, and then we had that pullback in the market there. So it is a fantastic leading indicator. And so essentially what credit spreads are, it's the difference between corporate debt and government debt. So government debt, very safe. You would expect them to have to pay a lower price or a lower yield. So government yields are obviously around that sort of 3 to 3.5% mark or thereabouts. But going out to the long end, you're up towards the 4 to 5% mark. But look, compared to say junk bonds or something that's a low credit, so obviously getting a credit card debt has a higher default rate, hence it has a higher rate. So you sort of compare it. So essentially, a junk bond or a corporate bond is a higher credit risk, so it should pay a higher yield for you to take on that risk. Essentially, the difference between those government bonds and the junk bonds is the most extreme spread. And when they're very flat, when they're very low, it means that investors are paying Well, investors are getting far too little for their money, for their risk that they're taking on, you know, high yield corporate bonds, and then we've got double A rated bonds are obviously very low here, and then triple C rated. So if these start to break out, these top ones here, that means that this blue will start to head higher, and then obviously that's overlaid on the S&P 500 there. So they're pretty inversely correlated, and if we start to see credit stress get back into the middle here, that's usually a really quality leading indicator. So I am gonna just go back to that on occasion, but I just wanted to explain it, explain it to you guys, so you're not. So you know what's going on when I refer to it later on. So as you can see here, our index was down a little bit yesterday. It was dragged down by energy and banking sector. There was some strength in the technology and lithium stocks. Woodside Beach Santos led the declines, major banks as well. Gold hovered near record highs, but the miners fell. Contrasting, there was some really big gains in the lithium and uranium producers. The likes of Life 360, Drone Shield surged on ASX 200 entry, and I think like little ones like Objective Corp, which I think scraped into the ASX 300, very thin stock. One of our small cap favourites here. That passive flow is really going to help small and liquid stocks like that on the tail end of the ASX 300. So. But yeah, look, Nikkei was up yesterday. There's a fair bit of geopolitical stuff going on here at the moment. So, Prime Minister of France lost a no confidence vote, and that forces President Emmanuel Macron to weigh on whether to hold a snap election or appoint a replacement. Concerns over France's growing debt burden, especially with 30-year bond yields hitting sort of decade highs across the board, pretty much in most places in the world, to be honest. So that those long end yields, are really putting a lot of pressure on governments, because that's kind of where they normally try to do a fair bit of their borrowing. And then as well, Japan's Prime Minister announced his resignation shortly after striking the trade deal with the US, which is leaving a pretty large power vacuum for the ruling Liberal Democratic Party. His sudden departure raised the likelihood of fresh political uncertainty in Japan as well. So, look, it's I think his party was recently defeated in the election anyway. But look, you've obviously got Trump. Putin launched one of the largest attacks on the Ukraine recently as well. I think it was the most amount of missiles fired at Kiev, and that's still sort of trying to work itself out. France has got issues. England's got issues. The US has got issues. Who doesn't have issues, essentially? So you can kind of understand why, obviously, the US market's just putting its fingers in its ears and closing its eyes and going, hunting for the positive, because they've got, what is increasingly looking like stagflation, which is the worst possible thing you can have for economies and equity markets. Basically, higher inflation and lower growth. It is a wrecking ball for equity markets and economies, essentially, and it takes more than a while to dig its way out. So I sort of think that Trump's fairly happy to see a recession, but probably not inflation. But he does need rates lower to get this debt refinanced. So, probably let the economy slip, and that'll help bring inflation down, and then it'll help bring rates down, I think, is probably the long-term game plan from, the Fed and, and Trump overall. So, we've still got strong buys across a lot of this stuff. The Dow was down last night. Well, the Dow was sort of up, very slightly, as was the S&P, NASDAQ and Russell. But to be brutally honest, it's lucky not to be down significantly after that horrible employment number last Friday. They're just basically, investors just fast forwarded to inflation. I'm pretty sure that if we get something in the threes in those inflation numbers, this market could be in a little bit of trouble, I would expect, because it's going to start to take rate hikes off the table. Rate cuts off the table, or at least the amount of rate cuts off the table. So the Fed's in a blackout now. They're not allowed to talk do any speeches or talk to the public about monetary policy until the meeting on the 16th, 17th. So, which is about middle of the month, obviously. We had Oracle overnight. It was after the bell. I haven't really had a chance to have a look at it at the moment. I'll just have a really quick check in terms of what the price reaction was in that stock there. It was up 2.4. It's up about 1% in the aftermarket. They're saying actually earnings results are expected tomorrow. So that'll be tomorrow morning. If some fairly small names really overall. GameStop more of a trading stock, and that meme stock, famous for that movie Dumb Money. Adobe might be watched, possibly just for spending. We've got Westpac Consumer Confidence and NAB Business Survey today. Could have a bit of an influence on the market overall. Iron ore was up 1%. That should help the materials sector. Lithium and uranium were up yesterday, but I think we probably kind of led that move. Crude bounced somewhat. Silver made a new 14 or 15-year high, depending on which one you're watching, the futures or the spot, around the $42 mark there now, and just looking more and more like it's just going to break to the upside. Everyone knows my general thoughts on silver and gold, but and people sort of keep asking. We just did a recent investment there. Is it? Do we think it's going to keep going higher? Well, the answer to that question is, do you think governments are going to get their act together? And the answer is no, they're probably not going to, judging by what's going on in France, what's going on geopolitically, and what's going on in the US. So, so that means that those stores of value are just going to continue to probably run a little bit higher. Copper was up a little bit as well. But look, no major moves. Everyone's eyes are now on that inflation number or anything to just generally distract them from the fact that we are sitting at really high valuations here as it stands. And one interesting sort of stat as well that I was having a look through last night, but China's exports to the US fell 33% year on year in August. So, which is not obviously a very good thing. Putin's economic advisors calling Bitcoin a scam. That was also pretty funny. And like I said, that that trade deficit sort of was year on year worsening, as well as the debt it continues to sort of spiral out of control. So I'm not overly bullish, as you can probably guess, but we're very much wait and see here at the moment. It doesn't mean that there won't be short-term opportunities, and but I would be very, very wary here as it stands at the moment, just on the back of a few things kind of lining up overall. But but hope everyone has a great day, and we will chat again tomorrow morning. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.